Zillow shareholders sue Zillow, Omicron's effect on the housing market, and COVID mortgage bailouts expire. That and more coming up. This is the Brandon Mulrenin Show. All right, so the news on Zillow just doesn't stop. So we all know that a couple weeks back in November, Zillow comes out and says, hey, we're done buying houses. We're gonna shut down our iBuying division. Fine, okay, cool. Then another story comes out where they start canceling contracts with homeowners that they agreed to buy homes with. They say we're backing out of some of those deals. And then this week, this is crazy. The Zillow shareholders file a class action lawsuit. And so what happened is, in this report, I'll read it, it says that the complaint filed alleges that throughout the class period, defendants failed to disclose to investors four things. Number one, despite operational improvements, the company experienced significant unpredictability in forecasting home prices. That means Zillow doesn't know shit about home prices.
Oh, isn't that what they do?
The Zestimate is not worth anything. Okay,
so property taxes are always wrong.
It's ridiculous.
Yeah.
Number two, they said that because of that unpredictability, as well as labor and supply shortages, led to a backlog of inventory. Number three, as a result of the foregoing, the company was reasonably likely to wind down its Zillow offer business, which would have a material adverse impact on its financial results. And then number four, as a result of that foregoing, the statements about the company's business, operations, and prospects were misleading. So here's what happened. So Zillow comes out there and they say, okay, we're going to start buying homes. We're going to start this iBuying division. We're supposed to make all this revenue. Investors take that information and say, hey, we want to give you some money.
Yeah.
And so this lawsuit is based on the fact that they believe that they didn't disclose any of this shit that was going down with Zillow and how much of a mess it was. And it's going to be interesting to see what happens. What are your thoughts on this?
I think that the truth will always set you free. You know? I mean, if you're transparent about that, I mean, obviously there's always risk when you make an investment, right? When you're investing in a company, there's always risk that that company is going to shut down. But with this, I mean, obviously there's a lack of transparency. There's something that was missing with how they explain things to their investors.
Well, I think the biggest thing with this whole Zillow iBuyer debacle that Zillow's not letting on was what I just said, was that this was Zillow, by the way. They are saying that their unpredictability in forecasting home prices comes out in 2021, where for the last 15 years, homeowners have been obsessed with what is my home worth on Zillow. And so nonetheless, I'm like, okay, finally Zillow comes out and says, we don't know anything about home prices.
Right.
And so that was interesting. Then the article goes on to say that on November 2nd, the company disclosed that it would wind down its home buying and selling business, which was Zillow Offers, their iBuying division. And this was, quote, okay, from Zillow, the unpredictability in forecasting home prices far exceeds what we anticipated, and continuing to scale Zillow Offers would result in too much earnings and balance sheet volatility. I think that's bullshit. They just couldn't, their algorithm on how they were buying these houses, they pretty much fucked up. They bought houses for way too much money. They realized it after buying 8,000 houses and like, all right, dude, we got to get out of this fucking business model, right?
Do you think it was so for me, I mean, the prices, I mean, so it value, so I'm not a real estate agent, right?
Yeah.
So I work in the mortgage
You're
world,
the finance guy.
Yeah. So I look at Zillow like is the Zillow home value, are they good at collecting data and reporting what that value could be based on public record, right? Like off the MLS, but really bad at forecasting it. Saying, because it sounds like where they screwed up wasn't, I mean, obviously you have to buy it right to make money. I mean, that's like the old adage.
Yeah,
right?
all the money's made in, that's exactly right.
On the buy, right? But they're blaming the whole thing on the forecasting, right? So they don't know, they screwed up in saying what these homes are going to sell for. You know, so I don't know.
Yeah, I mean, that's
interesting.
It's a good point.
Interesting thing, or it's like they wanted to go all in on the housing boom, right? They're like, we're going all in on the housing boom, iBuyer, we're ramping this whole thing up.
Yeah.
Only during a bubble. You know, not and I shouldn't say a bubble because we hate that word. I don't believe we're in a bubble, but during this time when houses are they like went all in while we're in the rise rather than
at the top of the market.
Yeah. You know, it's kind of interesting.
Well, the thing that you just said, though, you said, is Zillow good at collecting data? They're the best. Right. Nobody can compete with that. So here's the way I look at this. is for, I don't know, probably, I'm just going to say 15 years. It could be longer than that, right? I remember you and I writing mortgages together when Zillow was coming out with their Zestimate, right? And everyone was obsessed with the Zillow Zestimate. So from a data collection standpoint, yeah, they're phenomenal. They've been collecting data for a long time.
Yeah.
And the thing that frustrates me is that how much homeowners have emotionally invested themselves into what their home is worth on Zillow.
Yeah.
And all this time, Zillow leading people to believe that they can like put some weight into this Zestimate.
Yeah.
Then I believe, Steve, they used that data to launch this home buying, selling business model.
Yeah.
They only did it for a couple months and they're like, we're not very good at this. We need to get out of this.
Bad experiment, right?
It's a bad experiment. Yeah. And then they come out and say, we are not good at forecasting home prices. And so then they lay off 25% of their company. And then here's what they say, here's what happened next. So the article goes on to say, Zillow's shares after this news plummeted 23%, okay, on November 3rd on unusual heavy trading volume, while Zillow's Class C share prices fell 25%. So, I mean, it's going to be, I mean, they're in a mess right now. I don't know what they're going to do. I think this whole thing goes back to Zillow has a very successful business model, which is lead generation for realtors and now mortgage professionals. Yeah. I don't know who at Zillow says, okay, why don't we get into the real estate business? We'll become a real estate brokerage. We'll become a mortgage company. And I think, and I believe as an entrepreneur, as a business person, this is simply a case of them having their own shiny object syndrome. Going way too wide, not staying in your lane, trying all these different things. Stay in your lane, Zillow, right?
Yeah. I watch. You know what makes me think about? I'm out of things to watch on my treadmill at the gym. So I'm rewatching Narcos Mexico right now.
I got to watch that. You said it's good. It
is really good. But you know what Zillow did?
Tell me.
They did what happens to every good drug kingpin. They got high on their own supply, right? So they used their own stuff.
Great.
And then it took down their empire. They're like, our thing is so good, and all these people are investing in buying our leads and these. Yeah. You know, on Zillow too, like if you create an account on Zillow, you can go in and doctor up your
value of your home.
The value of your home. You can add rooms. You can add rooms in your basement, add your basement square footage to that, and all of a sudden,
Zestimate's
you're like, oh, I just doubled the square foot of my house. Like Zillow said this, So it's one of those things where Zillow they got so excited about that, and they're excited about the housing market. The company's making money. The same way they did in, Sinaloa, Mexico. Yeah. And everything's going pretty good. And all of a sudden they get into the cocaine business. Everybody figures out how great cocaine is, and down goes the empire,
That's an interesting one. Is that what you thought about on the treadmill this morning?
That's what I was thinking about, right? The whole time you were talking, all I could think about was Narcos. I don't know.
I got to watch that show. I got to get into that. I mean, so anyway, it'll be interesting. I want to really pay attention to this lawsuit, Steve, and see kind of, what's going to happen. Hold on. Yeah. So my father-in-law is calling. So this is on the show. This is live. RV, you're on a live show right now, my friend. Yeah, so. Yep, a lot of people need a lot of help. So let me call you back after the show. All right, bye. All right, back to the show. So let's leave that part in, don't you think?
Yeah, leave it in.
All right, so the next segment out in the show I want to talk about today is the new Omicron variant and how that will have effect on mortgage interest rates and potentially the housing market. So obviously, like everything else, the media they love their big titles. And so this article from The Street talks about what will the impact be with this new variant of COVID. So let's get into it a little bit, and I want your thoughts. This is your wheelhouse, but there's a couple key things in the article. We'll link to the articles beneath this video. But it says, generally, when there's an economic uncertainty, there's a big flight to quality where investors seek safe haven in more stable investments, such as U.S. Treasuries. Okay, so this is what the president of approved funding said. The article goes on to say that usually investors put their money into bonds and treasuries during uncertain times, and that investment funding tends to flow out of the stock market. But they go on to say that really didn't happen this year. I guess, what are your thoughts on whether or not this is going to have an impact on mortgage interest rates because of what investors are doing with their money?
Yeah, I mean so it did. It had a big it had a big impact on rates that day. So I think that came out. It might have been even like over the weekend or something. And then and we lost. This was probably 2 or 3 weeks ago now. We lost a ton of ground on mortgage rates, right? So rates are going up, probably up a quarter point. Omicron happens Monday, Tuesday, Wednesday. All those losses came back, right? So rates came back down. For me, that's like a lock alert, right? This is time to like take all these people, you lock all these rates. And as of today, especially after today's inflation reading, it's like Omicron was nothing.
Yeah.
Because now they're saying like, oh, you can, the third booster of this company's shot protects against it. You know what I mean? And they found out the Omicron, we dealt with the Delta variant, right? Which was much more I think the viral load or whatever it is was much more severe, right? So the symptoms were a lot more severe that you'd suffer, where Omicron wasn't as bad.
Yeah.
So it kind of came, it impacted rates, and then it left. But I think, the subtitle of this is investors could seek a flight to safety as new variant whipsaws the world markets. That's really what it is. It's a whipsaw. That's
exactly
why
right.
I tell the people that work for me, like, look, don't freak out. Like when you see news like this and rates go way up that first day, I'm like, don't go and lock everybody's loan. Like you got to wait. The markets will settle down. Things will come back. People figure out it's not that bad. And that also happens when they go down.
Well, and I took this as the thing I thought about, Steve, is on our last episode, we talked about all the information that came out that suggests that interest rates will go up in 2022, which we still anticipate they will.
Yeah. But
in this article, they talked about, will this be another reason why the Fed will decide to keep rates low? Because investors are worried. They're putting their money back into the bond market, where as we were coming out of this pandemic, and the economy is recovering.
Yeah.
So that's the way I took it. What's your take on that?
I think
to keep rates lower, I guess I'm saying, for a longer period of time.
I mean, when this was printed, so this was run, I know this article is from December 1st.
Yeah.
But the way inflation, so we had really, really good numbers with unemployment claims this week, and then inflation came out with its ass on fire.
Yeah.
And, for the second month in a row. And that's consumer price indexes, prices you and I pay for things. And it was on fire again. It's the highest overall inflation we've seen since like 1980.
Yeah.
And then there's what they call the core number, where they back out the prices of like food and energy, those things that can be kind of manipulated. So they back those out. And the core inflation numbers were the highest they've been since like 1991. So during those times, I mean, those were high inflation times. And so I think we're going to see the Federal Reserve continue their path to raising rates, because they've got to build tools. They have to have tools in their toolboxes for a recession. Everything's a cycle.
Absolutely.
So we went through a recession. We went through this whole pandemic. We went through all this. Everything fell through the floor. And now everything's starting to come back out of that recession. And we have to put all of our tools away, so that way we have something to use next time it happens.
Tell me about unemployment. So last week when we talked about, I mean that report was way off the mark. I mean, we anticipated there being over 500,000 new jobs enter the marketplace. It was like less than half, I believe.
Yeah.
So what was the job report this week?
So this week they're looking at unemployment claims. So that's new people filing for unemployment, right? So and that's at all-time lows. But there's also a lot of people out there that are not in the labor force. So it's a weird number to look at. Anytime you're looking at employment, is you have to measure how many people are in the labor force and how many people are on payrolls. Like there's so many people now, because as an employee, you have like a crazy amount of leverage right now, right?
Mm-hmm.
So all your seasonal holiday employees, seasonal
you got shit tons of leverage.
Yeah, all this leverage. Well, now they're like, well, I want to be paid in cash.
Sure.
So now a lot of this stuff is like off the books work, which these employers don't want that either, because there's deductibility and there's different things that you can do that it's better for your business to pay people on a payroll in some cases, So it's those numbers are really convoluted. The other part that's interesting too is that they're blaming a lot of this inflation on supply chain, right? So you're saying that the prices to get these goods is so high, but then you look at like Costco's shares are up like 17% based on their year-over-year earnings. So all these massive corporations are like breaking all these records for earnings right now and revenues, because the prices have gone up so much. But if the supply is so hard to get and it's so much more costly to get it, how are all these large companies claiming record profits? It's kind of an interesting.
Well, to me that makes sense.
Yeah,
it's a supply and demand thing.
Right.
I mean, right? So it's the same thing that we see in the housing market. You have the supply being at an all-time low,
right.
just like the supply chain.
Right.
That's why prices are high. I mean,
right.
so to me, the companies that are like the real estate companies are having record years. All the real estate agents at our companies are having record years. So to me, that Costco thing you're just talking about makes sense. I mean, if you know, so
people are paying the prices.
Absolutely,
like people just want
they got to eat.
Stuff. Yeah,
they got to eat.
100%.
They got to have houses. Yeah. You got it. So let's talk about. This other big news that came out, which was that the COVID mortgage bailouts, all of the relief for COVID mortgages are all coming to a head, right? They're all starting to expire. So this is really interesting too. So I want to talk about this article that was from, and we'll link again to this below, but this was from CNBC, okay? So this just came out, and they said that we're in the midst of the largest transition out of forbearance that we've ever seen. Okay, 750,000 homeowners are leaving plans have left over the past 60 days. Over half of the 7.7 million borrowers who were in these bailout programs are current on their mortgage, which is good, and making payments again, according to data from Black Knight, which I love, by the way. About 23% of the borrowers either sold their home or refinanced their mortgages to make them more affordable. Roughly 7%, or just over 500,000 homes, are in active loss mitigation with their lenders and trying to figure out a plan. So, what are your so to kind of give context around this story to the viewers? Talk about what has occurred during the pandemic that a lot of homeowners took advantage of.
So when the whole thing started, I mean, this was back in like April, May. I remember it was cold out when we were talking about it. So whenever that was, and that was in 2020,
right?
Was you could, I forget, I wish Bill was here, but he's sleepy.
He couldn't make it today. He was in bed.
But the word you had to, I forget what the word is, but you basically had to call your lender. And normally to do a loan modification, you have to go through like
hardship,
a hardship and an enormous amount of paperwork. I mean, you have to tell them how much money you spend on gum. They're like, listen, like, we're not just going to let anybody forego a mortgage payment for any reason. So, you know, when the pandemic happened, they basically came out and said, look, we're shutting down the economy. Like, we're shutting down the United States. All you have to do is call your mortgage lender and tell them you can't make your mortgage payment.
That's right.
And they literally put you into forbearance. And at that time, nobody really knew what was going to happen. I knew what would happen.
Yeah.
But you really didn't know. They're like, here's the options. Like, you can either, when you come out of forbearance, either have to pay a lump sum, you can divide it over a certain number of payments, or your lender will add it onto the back of your loan. It depends on coming out of forbearance. In my head, I'm like, there's no way lenders are going to be like, okay, so you haven't been able to work for the last 9 months. Thank you for re-entering the job market. Thank you for getting out of forbearance. You owe us $26,250.18.
Right.
The mortgage payment. So they're all doing the same thing. And what they did, which was actually cool. So, and this is, so loss, it should be known, like loss mitigation, like that doesn't mean foreclosure.
Absolutely.
Like,
which we're going to talk about in a second.
If you have, I mean, people can get into loss mitigation if their mortgage is, like with an underfunded escrow account, you're on auto pay, all of a sudden, like it rolls over 30 days, you immediately go into loss mitigation, whether it could just be an accounting error.
Sure.
You know? So what they did is in this loss mitigation process, that's normally when you'd go back through, and that's when they're going to modify the mortgage, right? So you go through forbearance, don't make your payments.
Yeah.
Then when you're ready to come out of forbearance or exit that program, you go into a modified loan. So if you don't pay the lump sum, you're in a modified loan, right? So normally you'd go through this loan modification through loss mitigation. And it's this, again, another long drawn out process. You really don't know what to do. Some people don't even know if you should make payments. So what the lenders and FHFA, which is a Federal Housing Finance Association, all these groups out there came out and said, we're going to streamline that process. And basically anybody who's got a federally backed VA, FHA, USDA conventional loan can just add whatever it is that they forewent to the back of their loan, start making payments at your normal payment, and everybody moves on. So that's what the majority of them did. So the success rate coming out of that, like I read something on Wednesday that initially there are 5 million homes in forbearance, 3.6 million have exited forbearance, 1.4 million still in forbearance, and out of those 3.6 million that have left forbearance, 0.65% fully went into foreclosure, which at the end of the day is 23,000 homes, which immediately got gobbled up by demand.
Yeah.
I mean, there's such a demand for houses right now.
Absolutely.
And you slap the word foreclosure on a house, and your offers and your interest in that property are going to quadruple.
Yeah.
Because everybody's been waiting for a foreclosure.
For a good deal.
Yeah, so immediately you think you're going to get a good deal when who knows?
Yeah.
You know, so.
Well, the thing is with the whole forbearance thing, I mean, the success rates make sense because there are so many people that didn't even need mortgage relief that were taking advantage of that.
Yeah.
I mean, to your point, it was like a simple phone call to the bank and like, hey, I can't make my payments. They're like, all right, no worries. So there was millions of people. I can't even imagine how many millions of people did that. But here was the thing about the article that I found was interesting, right? So I don't know when this was. It had to have been a couple months ago when we talked about whether or not the housing market would crash. And we talked a lot about in that show about equity positions. And so did this article. And they said about 87% of homeowners currently in foreclosure have positive equity. So these borrowers owe less on their mortgages than their homes are worth. So what was interesting about this, and here's how the breakdown worked. Roughly 73% of borrowers in foreclosure have more than 20% equity, and about 28% have more than 50% equity. So the thing is that's different now than what we saw in 08, 09. These people can sell their homes,
I know, that's what's so sad. Like how it's a miss by whoever's in, if you're this person that you're going to foreclose on your home and you've got 30% or 50% equity in your house. I mean, I don't know how at this day and age with the way information travels, how you end up where you don't have anybody in your circle to be like, dude, you are not foreclosing. Figure out how to make that payment and sell this bad boy and get some money out of it. It's
just, well, let me ask you this.
That's a huge bummer.
Yeah,
that people don't have that.
Yeah. Well, I don't know. We're going to see. I mean, the report's talking about that these people in foreclosure. I mean, they have it. They have some options because the people that have been out of work. I mean, refinancing, because we talked about that for people that don't have a job that lost their job due to the pandemic. They can't refinance.
They can't. No.
Right. So it's like we'll just sell the house. Sell the house and walk away with some upside of the equity. Right. That's why I think that these reports, in my view, I think the foreclosure is going to be very, very, very insignificant when we get into 2022.
I think like you mentioned, loss mitigation. I think there's going to be a lot of workouts as well. The other thing that's challenging is that we aren't talking about, because I mean, I'm not really interested in rental rates because it doesn't do me any good. But, I mean, think about how high rent is. I mean, it is so much more affordable to own a home than rent right now.
That's right.
You know what I mean? So it's kind of like, where are they going to go if they do foreclose?
Yeah.
That's the tricky part.
Yeah. So, like we always do to end the show, it's time for closing arguments. Let's talk about buy, sell, or hold. Okay? Your thoughts right now as we end 2021, going into 2022. Your advice for the buyers and sellers that watch the show: should they buy, sell, or hold?
So right now, if you are in the market, if you're looking at moving, do it now. There's no sense in waiting. And some data that I looked at. So, and I've been talking about this for days, and I don't even know how to put these. Like, I'm not a super good stats guy, Like, I have these.
I think you're pretty good.
I have these concepts in my head, but I don't know how to get them out there sometimes.
Sure.
But so right now, that the average age for a first-time home buyer is 33 years old.
Yes.
Right?
Oh, I did see this too. That's
so
good.
if you look back in 1983.
Yeah.
Okay, so that's, or 1980, whatever. What is it? It's 2021, so 1988 would be a 33-year-old, roughly.
Yeah.
There's 5 million people that will be coming into the market in the next 12 months turning 33 years old.
That's a great point.
And you look at bubble data, right? In 2007, we had 5 million homes in the inventory for sale, right?
Sure.
And there is 116 million households in the United States that would have these people leaving to buy houses.
Sure.
Right? So we look at 2020, there's 128 million households looking to buy houses.
Yeah.
And we have 1.2 million homes in our inventory. We're currently 4 million homes undersupplied. And we've got the next 7 years of rising birth rates from 1988 to 1994, where there's going to be 5 million, 4 million, or 5, I don't even know. Oh yeah, 4 million or more people turning 33 every year for the next 5 to 6 years.
Yeah.
So if you're thinking of like saying, oh, I want to get the maximum out for my house, look, we did the run up,
Yep.
right? So
Absolutely.
that's going this way, and it's going to turn like this,
Sure.
right? So you're at the max what you're going to get for your house, but if you're going to wait 2 years, you're not. There's not enough of a gain. Take advantage of the rates now, because we know for sure rates are going to go up.
Yep.
We know that home prices are going to go up, and we know that the group of people buying homes is like an endless ocean, right? I mean, it's like the parking lots of GM trucks looking for chips. Like the more chips we get, we don't have enough chips. So we got all these people waiting for a chip, you know? And so it's the same thing, you know? So my thing is right now, if you want to move, do it. I mean, just take action and do it. If you don't, and you're going to stay in your home, get some cash out of that bad boy if it's not set up exactly how you want it, and make your house your own and stay there and lock in the low rate. Or if you have a bunch of equity and everything is good, just stay and be happy.
I see it the exact same way. I mean, my position on that is waiting has no strategic benefit based on the data. This is not an emotional thing. Like based on the data that we look at every single week that we report on this show, there is no data that suggests that waiting benefits a seller or benefits a buyer.
Yeah.
It's actually quite the opposite.
Yeah.
It's the counter argument that waiting actually could hurt. So if you're on the fence about buying or selling, do it now. So last question for you, and then we'll end today's show. You wearing pants today?
Yeah.
Okay. People have been asking. You know, you guys got pants on underneath there?
Yeah, I got pants on. They're green.
Oh, those are nice pants.
I know.
So I want to ask the audience something. Do you guys want to, because we talked about, you know, potentially underneath the attire to wear like some sporty shorts.
Yeah.
And then every episode we can stand up at the end of the show and they could see kind of what's going on under here.
I'm a big compression short guy.
Yeah, I know you are.
I mean, I'm into it.
What do you guys want to see? Thank you guys so much for watching. We'll see you on the show next week.